Assalamualaikum warahmatullahi wabarakatuh. Hong Leong Islamic Bank Berhad is the Islamic bank subsidiary of Hong Leong Bank Berhad, offering Sharia-compliant financial solution within Malaysia's dual banking system. The bank supports ethical and responsible finance by integrating Sharia principles with strong governance and risk management practices. The key focus areas include Sharia-compliant retail and corporate banking, financial inclusion and customer-centric solutions, and sustainable and value-based banking practices. The core offerings that they offer are financing products such as murabahah, ijarah, and musyarakah mutanakisah. Other than that, investment and deposit product based on mudarabah and wakalah. Operations are regulated by Bank Negara Malaysia and align with national regulatory standards and prudential requirements. For economic condition and industry, Malaysia's economy recovered strongly after the pandemic, rebounding from a 5.6% contraction in 2020 to growth of 3.1% in 2021 and peaking at 8.7% in 2022, driven by domestic demand and tourism. Growth moderated to 3.6% in 2023 before strengthening again to 5.1% in 2024. To support recovery, Bank Negara Malaysia maintained the OPR at a low level of 1.75% during 2020 to 2021 before gradually normalizing it to 3% by May 2023, where it remained through 2024 to balance inflation and growth. Despite economic and monetary policy shift, Malaysia Islamic banking sector continued to expand, reaching close to 48% market share growth between the year 2000 and 2024. Hong Leong Islamic Bank Berhad performance mirrored this trend, with gross loans and financing growing 7.3% to 194.9 billion ringgit in 2024, where profit before zakat and tax increased to 853.7 million ringgit, reflecting strong resilience through economic normalization.
Next, I will discuss the profitability and sustainability indicator. First one is ROA. Between 2020 and 2022, we can see that ROA declined from 0.94% to 0.62%. This was mainly due to the impact of COVID-19, whereas economic activity slowed down and the bank had to make higher provisions. However, as the economy started to recover, the bank's performance also improved. ROA increased to 0.79% in 2023 and slightly higher to 0.81% in 2024. This shows that the bank is managing its assets more efficiently as financing activities pick up again. Overall, an ROA level between 0.75% and 1.0% is generally considered healthy. Even though Basel III does not set a specific benchmark for ROA, the recent improvements suggest that Hong Leong Islamic Bank remains financially sound and resilient, especially in a more stable and improving economic environment. Next is ROE. From 2020 to 2021, ROE was relatively stable at around 12.15% and 12.08%. However, in 2022, it dropped to 8.60% due to post-COVID economic challenges, even though the bank's equity continued to grow. As the economy became more active, ROE rebounded to 10.77% in 2023 and slightly increased to 10.79% in 2024. This upward trend reflects higher earnings and more active economic activity. While Basel III does not set a specific ROE benchmark, it emphasizes sustainable profitability to support capital adequacy, risk management, and long-term resilience. Overall, the bank's ROE pattern shows that it is gradually providing returns to equity holders in a steady and sustainable way, aligning well with Basel III's goals for financial stability and long-term resilience. Next is ROD. In 2021, ROD was 1.08%, but it dropped to 0.76% in 2022, reflecting the challenging economic condition after the pandemic, higher operating costs, and increased funding risk. As the economy improved, ROD recovered to 0.95% in 2023 and slightly increased to 0.96% in 2024. This shows that the bank is managing its deposit prudently, taking advantage of funding growth, improving margins, and raising interest rates. Although Basel III does not set a specific benchmark for ROD, a ratio around 1% generally indicates effective deposit utilizations and sound liquidity management. Lastly is the profit margin ratio. The margin increased from 21.35% in 2020 to a peak of 26.88% in 2021, reflecting efficient cost management and strong revenue recovery after the pandemic. However, it declined to 20.60% in 2022, 19.65% in 2023, and 18.11% in 2024, indicating that profits weakened relative to revenue. This decline was mainly due to the higher operating and compliance costs, increased impairment provisions, and margin pressure from inflation and tighter monetary conditions. Although Basel III does not set a specific benchmark for profit margin, margins above 15% are generally considered healthy for banks. Overall, the trend shows that Leong Islamic Bank remains profitable and continues to manage risk and cost prudently, even in the face of challenging economic conditions.
In this part of the presentation, I will explain about efficiency and productivity indicators and the portfolio quality indicators of Hong Leong Islamic Bank based on our financial ratio analysis. Firstly, under efficiency and productivity indicators, the operating expenses ratio measures how efficiently the bank control its operating costs in relation to total income. From the year 2020 until 2022, the ratio increases and reached its higher level at 18.11% in 2022. This increase was mainly due to higher operating and compliance costs during the post-pandemic period. However, as economic conditions improved, the ratio declined to 13.25% in 2023 and further decreased to 11.74% in 2024. This downward trend indicators improved cost management and operational efficiency, which support profitability and indirectly strengthen capital in line with Basel III principle. Next, the cost per unit of capital allocated shows how efficiently the bank uses its equity to support operations. The ratio declines steadily from 8.07% in 2020 to 6.10% in 2024. Although there was a temporary increase to 7.56% in 2022 due to higher costs during the pandemic, the overall trend reflects improved capital efficiency to support Basel III's objective of sustainable capital management and long-term financial stability. Moving on portfolio quality indicators, the financing loss reserve adequacy ratio measure the bank's ability to observe potential credit losses. The ratio increased to 0.56% in 2022, reflecting higher impairment provisions during the pandemic when credit risk was elevated. However, the ratio declined to 0.27% in 2023 and further to 0.08% in 2024. This indicates that impairment allowance did not increase at the same pace as gross impaired financing. Although Basel III does not prescribe a specific benchmark for this ratio, maintaining adequate reserve is important to protect capital and ensure portfolio quality. The decline trend highlights the need for continued monitoring of credit risk to maintain long-term financial stability.
Financing portfolio growth. For the financing portfolio, the bank showed a healthy negative lending trend. Growth stood at 8.7%, 11.33%, and 12.9% in 2023. Although Basel III does not set a specific standard for financing growth, it emphasizes standard expansion with strong capital support. The double-digit growth, particularly in 2032-2034, reliably reflects post-pandemic recovery, stronger demand, and improving economic activity. Overall, this trend indicates strong business performance while still remaining consistent with prudent baseline risk management. Equity growth. For equity growth, the bank also shows strong capital position. Equity increased by 11.74% in 2021, slightly slow to 5.5% of 2022, but strengthened again in 2023. Even though Basel III does not represent a specific benchmark for equity growth, it stresses the importance of maintaining strong capital buffer. The slower growth in 2022 likely reflects post-pandemic adjustment, while the stronger growth in 2023 and onward indicate improving profitability and capitalization. Overall, this positive outward trend support baseline financial stability and readiness to face economic uncertainty. Current ratio. For the current ratio, the bank record the gradual improvement. It moved from 0.83 in 2031 in 2032 to around 0.85 in 2034. Although still below 1, this is common in bigger session because bank rely heavily on deposit and short-term funding rather than holding large amount of liquid asset. Basel III also does not set a direct requirement for current ratio, but maintaining sufficient is important for financial stability. So the gradual increase reflects questions and discipline, equity management, and sustained economic conditions. Debt to equity ratio. For the debt to equity ratio, the bank shows moderate reduction in leverage over time. This indicates the bank is more equity financing and less on debt, which enhances financial stability and reduces risk exposure. Although bank does not specify as a debt ratio, maintaining control level support capital adequacy and resilience. The higher ratio seen in 2031 to 2030 were likely influenced by economic slowdown and post-pandemic uncertainty, where bank depends more on borrowed funds to sustain operation. Overall, reduction indicates healthier and more balanced capital structure. Debt to asset ratio. The bank debt to asset ratio remained relatively stable, staying around 0.93 from 2031 to 2034. This means about 93% of the bank assets are financed through debt, while the rest is funded by equity. Although this is high, it is normal in the banking industry because banks primarily operate with deposit-based spending. This slight decline of assets indicates small reduction in risk exposure. Under Basel III, maintain maximum level of leverage support capital adequacy and financial resilience, ensuring the bank has sufficient equity buffer. Capital adequacy ratio. The bank recorded potential over the 5-year period. CTR measures how much capital bank hold related its risk-weighted asset and its ability to absorb loss. Under Basel III, banks are generally required to maintain at least 8% with highest potential for significantly important banks. The earlier decline may have been caused by pandemic pressure on earnings and asset quality, while later recovery reflects improved economic conditions and stronger capital management. Overall, maintaining CAR above the minimum indicates the bank is adequately capitalized to support growth and withstand financial shocks. Asset quality ratio. Lastly, the bank asset ratio showed further improvement over the years, increasing from 0.047 to 0.045 in 2024, reflecting better efficiency in using assets to generate income. Although Basel decided not specify benchmark for ratio, improving stability support legal qualities such as strong income migration, capital strengthening, and maintaining liquidity. This upward trend also like post-pandemic recovery and better investment performance.
Evaluation against Basel standard. Hong Leong Islamic Bank Berhad maintains a strong capital and liquidity position with CET1 and LCR ratios consistently exceeding Basel III and BNM CAFIB minimum requirements, providing strong loss absorbing capacity. High operational efficiency supports capital strength, with staff productivity doubling to 20.57 million ringgit per employee in 2024 and an operational sustainability ratio of 3.05 times. A potential risk lies in the lower financing loss reserve ratio of 0.08% in 2024, which may require higher provision if economic conditions deteriorate, potentially impacting profitability. During the pandemic period in the year 2020 and 2021, low OPR and higher provision reduced returns, with ROA falling to 0.62% and ROE to 8.60% by 2022. The year 2023 and 2024 recovery, supported by OPR normalization to 3% and lower unemployment, which is 3.3%, improved margins and efficiency, lifting ROE to 10.79% and supporting 11.41% financing growth in 2024. Going on to the recommendation part, firstly, Hong Leong Islamic Bank Berhad need to strengthen their capital base. They should continue prioritizing the growth of CET1 capital through returns earning. A stronger core capital base will provide greater flexibility to support future financing growth, regional expansion, and potential increases in regulatory capital buffers under Basel III and CAFIB. They also need to reinforce loss buffer. While current asset quality remains strong, the recent decline in financing loss reserve suggests the need for more proactive provisioning. Building higher reserve during stable period will enhance resilience and reduce the impact on profitability during future economic downturns. And lastly is to sustain efficiency through digitalization. Continue investment in digital platform, automated Sharia compliance, and data-driven credit assessment will help maintain operational efficiency. Strong efficiency support earnings retention, which in turn strengthen capital and support long-term sustainability. In conclusion, Hong Leong Islamic Bank Berhad successfully navigated the economic challenges between 2020 and 2024, transitioning from a defensive position during the pandemic to a phase of strong recovery. Despite the decline in returns during the pandemic period, the bank closed 2024 with a profit before zakat and taxation of 853.7 million ringgit, supported by improved staff productivity and disciplined cost management. ISB's growth was driven by strong asset quality rather than excessive risk-taking, as reflected in its low gross impaired financing ratio of 0.53%. At the same time, the bank remained firmly compliant with Basel III requirements, supported by a capital adequacy ratio of 9.18% and solid equity growth in 2024. Overall, ISB's strong capital position, operational efficiency and prudent risk management place it as a resilient and competitive player in Malaysia's Islamic banking sector.